Hi, I'm Eric France, a commercial disputes partner at UK national law firm Mills and Reeve. Today I'm speaking with John Astill about litigation funding. John is a director at Exton Advisors, specialist litigation, finance and insurance advisors. Hi, John. The coronavirus pandemic looks likely to lead to increased numbers of claimants with cash flow problems, as well as an upswing in the overall number of disputes. Third-party funding could be the difference between survival and insolvency for some claimants. In your view, are large numbers of claimants going to be able to access funding, or will it only be for the relatively narrow range of very high-value disputes, John?
Yeah, thanks, Eric. I think there's a perception about litigation funding in that it only serves cases that require multi-million-pound investments, and this is simply not the case anymore. I think as the market's developed and funders have found their own niche in terms of size and types of cases. And yes, there are funders who have a minimum threshold of investment, but equally there are funders that will invest in cases where the funding required is considered relatively low, particularly where the requirement is for disbursements only. Furthermore, we see litigation funding more as a solutions-based product and not simply for funding legal fees. I think with pressures on cash flow being a real risk to companies over the coming months, we're starting to have conversations with companies who are keen to review how they can manage the liability of litigation and seek the support of litigation funding to monetize some of their claims. And this applies to both large listed business and SMEs.
How do funders currently price their funding? And do you expect that to change at all as a result of the pandemic?
Yeah. I mean, this is one of the first questions we're asked when we first meet a client to discuss funding. How much is it going to cost? The simple answer is that all funders structure their investments based on a number of factors such as perceived risk, time horizon, cost of capital, which ultimately leads to an IRR calculation. The cost of litigation funding, i.e. the basis on how the funder makes a profit return on their investment, tends to be based on either a multiple of the investment, which could be anything from 2 to 5 times multiple, a percentage of amount recovered from the defendant, typically between 20 to 50%, or perhaps an interest rate on the funding facility itself, or possibly a combination of any of these. Now, and some people think that it's expensive. And I've spoken to plenty of funders about this, and their anecdotal answers are usually pretty similar. I mean, for example, let's look at a Series A investment, which is by definition pretty risky. Funds that make Series A investments typically look for approximately 30% of the equity in a new business, or perhaps a return of 3 times their investment. And this is not dissimilar to how a litigation fund approaches investment to reflect the inherent risk of litigation losses. Litigation funding is a binary investment. The result is a win or a loss. And a bit like new businesses, they can do well, in which case you make a decent return on your investment, or they fail pretty quickly and you can lose your investment. I think if the pandemic does lead to a golden age of litigation funding, it's going to be more important than ever that claimants take proper advice if they are seeking litigation funding and don't get caught up in a market driven by supply and demand. Presently, there is plenty of capacity in the funding market, but I think as demand increases, the funders will begin to cherry pick even more and I suspect adjust their pricing accordingly. We're working hard with our clients to make sure cases are presented in their best light, to ensure we attract the funders' attention and are able to negotiate the most favourable funding structures and contractual terms.
Is third-party funding only for claimants who can't afford to fund claims themselves, or can it be useful, even where cash flow isn't an issue for the claimant?
Yeah, I mean, historically, litigation funding was seen as a distressed purchase where claimants sought funding where they were unable to pursue their claim due to lack of funds. However, we are beginning to see more companies look to litigation funding as a way to manage their cash flow, i.e. rather than funding litigation from their own cash flow, they're looking to the litigation funding market to make an off-balance sheet investment in their litigation and potentially across their portfolio of disputes. I think although companies have to give away some of the upside of the recoveries, rather than committing cash flow to litigation, which could take upwards of 3 years, they're able to redirect that money into other areas of the business that require investment. I think, as I mentioned earlier, we expect to see more of this as cash flow gets squeezed over the coming months. And that equally applies to historically large, well-funded businesses that are going to be taking a long, hard look at their cash flow requirements over the coming months. There's no question that litigation and litigation funding is on the rise, particularly with the current economic difficulties so many companies are going to be facing. There is all manner of options out there for claimants, and navigating a way through is not always straightforward. So I would stress that even more important than ever to take well-balanced advice on attracting not just the funding itself, but the right funder.
Thanks, John. These are general points, and if you need specific advice about your circumstances, you should get in touch with us or a specialist advisor like John. John's and our own contact details are in the comments section below. Thanks, John.